In this video, John Kolovos, who is a chief technical market strategist at Macro Risk Advisors, says despite this recent downturn in the markets, there's an expectation for the market to find support around 5,800 and recover on the S&P 500, with projections of double-digit growth in 2025 due to favorable long-term financial conditions, even with rising interest rates. John says overall, while short-term challenges exist, the fundamentals suggest a gradual recovery and broader market improvement ahead.
Right, so we should continue to see the market pull back. I don't think we'll get as low as the 200-day moving average. My guess is, we'll find support somewhere around 5,800 and then start to work our way back up.
But why are you more optimistic in the longer term? Expecting as much as double digit? We're having two now back-to-back years with more than 20% gains.
Yeah. So I think we could do that. Reason being is that even though interest rates are going up, financial conditions haven't tightened yet, right? And that to me is like the main bullish case you can make from a technical perspective. I'm primarily an equity guy, but I listen to the fixed income market so closely, and until financial conditions tighten, either credit spreads or Moody spreads, triple Bs.
You don't see that, even with this move up.
I don't see it yet.
Because we are seeing higher yields and a stronger dollar, both of which I think you expect to continue.
I do think yields will go up over time. I think yields are in a multi-year uptrend, so I think they're going to go up for long periods of time. And I do think that stocks and interest rates can get along. I think cats and dogs can get along in this scenario, like they did in the 50s and the 60s. If you actually were to see a chart of the S&P during that time frame, they both went up concurrently. I think we're going to that period.
What, because the economy is just so good?
Yeah, it was more of an inflationary situation. We just went through like a decade of deflation. Now we're reflating right now. So I think we can continue to see that, but what's happening is that the equities are going through a bit of a hissy fit, a bit of a tantrum every now and then. So while I think interest rates will get to maybe like 5.25 to 5.5 next year, I don't think it'll be enough.
5.5?
Yeah, could get that way. That's what the charts imply.
People are wondering if they should be freaking out now about 4.6.
Yeah, I know. Well, they have to get used to it.
Huh. What about the NASDAQ? Does that mean NASDAQ continues outperformance?
I think NASDAQ has the ability to be a market performer. And I think what's going to happen next year is we're going to see a rotation out of these momentum winners. So if 24 was about breadth expanding, 25 is going to be about whether or not that momentum gravy train is going to continue or not. So but what I mean by momentum is like those outperformers as a factor, the momentum as a factor, whereas should we be buying laggards, like the ones that are down and out of 52-week lows? The answer is no. I think what's going to happen is we're going to rely less on tech, we're going to rely less on financials, we're going to rely less on industrials, but we're going to start looking a little bit more at the cyclical laggards, like in energy, materials, and parts of discretionary.
Where does that put small caps? Because that's been a big question lately.
Right.
Looks like they're going to close the year up more than 10%, but still underperforming when so many people were optimistic this was the time.
Yeah, and it was right after the election was a massive breakout for small caps. You got it, petered out, and now you're down quite a bit. You retraced more of the election rally.
Tough month, December.
Very tough. We're very close to the 200-day moving average. I'm going to give it breathing room. So long as it stays above the 200-day moving average, I'm going to give small caps the benefit of the doubt. And the back test that I have done does show that the market should continue to broaden out next year. So what do I mean by that? It means that breadth should improve. So this is a pullback that I think the market is using, or market participants will be using as an opportunity to get stocks that were overbought after the election at a better price right now.
So you don't see the run-up in the mega cap stocks and the outperformance as tied to the higher interest rates?
Not necessarily. How I would put it is this way. At some point, the euphoria that was created after the election will be wringed out, and I think that we're in that process right now. At that point, then the average stock will start to work its way higher, and that's when things will get back into gear again with interest rates and the average stock. Right now, I think we're just having a bit of a shakeout, year-end, profit-taking, whatever you want to call it. But I think that's ultimately how we work our way higher. A sentiment extreme, a bearish sentiment extreme, and those parts of the market should create an oversold condition, and then the market will pull itself.
And how do you get to 5.5% on the 10-year?
How do we get to 5.5%?
That's so out of consensus.
Well, there's different types of measuring techniques we do as technicians. One of it would be if you just would assume that the last couple months were just that pullback in interest rates was a consolidation in rates. You're just going to resolve it higher. It's called a measured move technique that we have, and it's just based purely off of the chart, to be quite frank.
But you think it's going to be cool for stocks?
I think it'll be okay. Right. But the trick is the volatility of it. That vol has to be low, and that'll be all right.
Well, John, it's good to have you here in town. John Kolovos at Post 9.